What's up, guys? And I'm finally back from a really tough bout against COVID. And you know what, guys? Before I left and took my break, so to speak, I actually made a video on how do you spot market bottoms. And that's a video that I never really got a chance to edit. And so finally I've edited it and here it is. And so guys, as you guys smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. Now, a question I get a lot is, how do you catch the bottom of a falling market? When do you know when it's time to deploy a ton of your capital, especially for someone like myself who really does like to sit with a lot of firepower, dry powder, when the market is kind of moving up? And so how do we sort of like determine this? And so that is the question for this Q&A series video. Now, in retrospect, it was easy to see that in March and April of 2020, these were actually good times to go all in on the stock market. But how do you spot it while it's happening? Now, the other thing is, it's only a good time, it only is a good time to go all in retrospect, because there was quite a bit of quantitative easing that happened, and effectively the recession got canceled. And as time goes on, the market could very well just nosedive back down and go even further down. And so this may not necessarily have been a great time to invest because the market could have continued to go down. But the way I thought about this in March and April of 2020 is that there were reports coming out saying that, this virus situation could be bad, but worst case scenario, they were saying that like a vaccine could get developed in like 3-4 years. And so I was thinking, okay, yeah, well, I don't think that this is an apocalypse scenario. I don't think this time it's different. And so what I really did was I started looking at my tracker and seeing if there was any interesting opportunities as a result of the stock market going down this far. And so that leads to the next question. What exactly was my secret to catch the market bottom? And in fact, I had put a ton of my money. That was the last time that I was fully invested. I had taken all of the cash that I had and I bought up securities at that time. And, thankfully, I'm grateful, but, we're sitting in a really nice house as a result of some of those investments that were made at the time. And truthfully, the answer is I had no idea. All I had was my research, and I really expected that the market was going to go down another 50% at the time that I was making the investment. So I was very scared and I was reluctantly deploying the capital at that time. But why did I even decide to deploy the capital? Well, I talk about this all the time. I have my tracker, and the help that I get from the tracker is that, I organize all of my research, and every day the stock market updates the stock prices. So I have a live view of what the share price is as a percentage of the intrinsic value of the security. And so really what I did was I went line by line down my tracker and I said, well, what is the impact to the long-term intrinsic value for this particular company? And some of those companies, the answer was I don't know, and so those I would skip. And some of them were, I don't think this company is going to be materially affected over the long term. And so as a result, I would deploy capital into that particular opportunity because it was trading at like 20% or maybe 30% of its intrinsic value at the time. So that's kind of how I was doing it. But I also anticipated that there would be so many things that I wouldn't necessarily be able to understand or predict. And so although I was deploying capital when these things were very cheap, I also had in the back of my mind that, things could get even cheaper as a result of the market falling even further based on stuff, once again, that I wouldn't be able to predict. And so investing in a time of panic isn't actually as easy as people think it is. It's actually very difficult to deploy capital. You're almost kind of just like closing your eyes and saying, hopefully this plays out the way that I anticipate that it will play out. And so that's where, where Buffett and Munger and et cetera, they'll talk about having the emotions to deploy capital. That's really, really when it counts. And this is exactly what I'm talking about. Warren Buffett has spoken about this, and he said, unless you can watch your stock holding decline by 50% without becoming panic stricken, you should not be in the market. And so anytime I was investing capital into those particular securities, I was asking myself, and you know what, I do this till to today. Every time I buy a stock, I ask myself, how would I feel if the stock declined by 50% or more? And since I already buy at a 50% of the intrinsic value or lower, or I try to buy the stock at 50% of its intrinsic value or lower, the answer is always to buy more when taking portfolio diversification into consideration as well. And so, if I bought the stock at 50% of its intrinsic value and now it's selling at 25% of its intrinsic value, then I absolutely should be deploying more capital. So in those types of situations, it almost like I would be making a mistake not deploying capital, even though the market is very panic stricken, because at the end of the day, it's hard for me to control my emotions. I also feel the panic. I feel the stress as well. In March and April of 2020, I felt a lot of stress when I was deploying capital. And, some of my best friends and smartest friends were saying, hey, wait a couple of months to let this thing play out. But, I said to myself that, like, if I wait a couple of months, this thing could reverse very quickly. There was already conversations about QE and giving people money to stay home, etc. There was already that kind of talk happening, and I knew it was just a matter of time before the market calmed down and many of these opportunities would go away, and that it actually ended up being what happened. Now, keeping that in mind, I also said that it could very well get worse. And so, part of it was just like I happened to get lucky because the right people stepped in and saved the economy when it needed to be saved the most. And this goes to the next tip, I would say. And, this is not investment advice. It never really is. But, when your smartest contrarian friends swear that the market can decline much further, you're probably likely near the bottom. Because even if, like value investors, we're very rare. And even if we start getting scared, that might be a good indication that the market is probably near or close to near of its bottom. And let me give you an example. I remember this one very vividly. In October of 2008, when Warren Buffett actually penned the op-ed for the New York Times, which was titled Buy American IM, what ended up happening was I was talking to a lot of my value investing friends, and a lot of them were saying, no, it's not time. Things can get much worse. And I still remember that to this day. And I thought to myself, you know what? It's probably not a bad time to buy. And I actually started buying stocks in this period, and it ended up being a good investment, in hindsight. And, this is what Buffett wrote here. The financial world is a mess, both the United States and abroad. Its problems, moreover, have been leaking into the general economy, and the leaks are now turning into a gusher. In the near term, unemployment will rise, business activity will falter, and headlines will continue to be scary. So I've been buying American stocks. What a well-written paragraph. And he pretty much encapsulated what all major declines feel like. Now, keep that in mind, because stocks actually fell another 30% from the day that Buffett said he was buying stocks. So even Warren Buffett couldn't catch market bottoms as it related to this very famous article that or op-ed that he put out in the New York Times. So just keep that in mind, that if the greatest of all time can't catch the bottom, give yourself some latitude. You might, make a really great investment, but it goes down another 50%. A lot of people bought Alibaba at really good prices, like $100 per share for the company, and it fell down to like $70 per share. Was $100 per share not a good price for Alibaba at the time when you guys were paying it? Probably not. In hindsight, it'll probably end up being a very good price. And so give yourself some latitude. You did your work, you did your research, you know what the company's intrinsic value is, and you bought at less than 50% of its intrinsic value. And so, the moral of the story is to always follow the story, not necessarily the stock. And, if the story suggests that over the long term, this company's valuable to humanity and it has a place in society, I would obviously purchase the stock. Now, I'll give you guys a very famous example of this. So this is from Peter Lynch. He said that, in 1972, the shares of Taco Bell were going through a major correction. In just a short time, the stock price was cut in half from $14 to $7. And Lynch, who, saw the value of Taco Bell, started scooping up shares, and so the shares kept sinking, and they eventually hit $1 a share. So that was an 85% pullback from even the $7 level, which Peter Lynch started buying. And what did he do? He didn't chalk it up as a loss. He just said, look, if it was a value at $7, the story remains the same. So he kept buying even though it hit $1 per share. Lynch knew the real story. The company had no debt and it continued to see strong growth, which meant that the pullback in the stock's price was a great opportunity for patient investors. And, in hindsight, he was absolutely right. Once the dust settled, Taco Bell was acquired by Pepsi for $42 per share, making a five-bagger from Peter Lynch's original price. Meanwhile, the stock going from $1 to $42 is, of course, a 4,100% gain. And so the moral of the story is, do not give up on businesses that you understand. And the macroeconomic environments and shocks to the securities markets may make you double guess yourself, but always go back to the story, go back to the financial statements. Does the company make sense? Is your model taking into account all reasonable situations? Are you being conservative in your valuation? Is the company selling for a material discount to its intrinsic value? And go with that. And so that's generally how I've been successful. Now, I'm not going to call myself a great investor or anything like that. I'm average at best. But the point is that if the question is how do you spot a market bottom, the truth is you really can't. But what you can do is utilize your tracker and allow it to tell you when there's actually some interesting investment opportunities. Now, if you want access to the tracker that I provide, you can get access to that tracker at the low price of just $5 a month. And I really do believe that that's the best value on YouTube, because it gives you access to all of my research and what my opinion is of what certain companies are valued at. And so, I believe that this Q&A series is probably the most value that I can provide on this channel. And so I've condensed all of the videos, or put all of the videos into a playlist. And so if you've missed any of the videos, no problem. You can get access to the whole playlist right here.